Hey, this is Sasha Evdokov, and thanks for joining me here at tradersfly.com, where I share with you some insight about trading, investing, and the stock market. Now, in this week's episode, what I'd like to do with you is share with you what is beta and how can you use beta on the stock market tables to make trading decisions or investing decisions for your personal portfolio. So first off, before we even get into what is beta, the more important question is why would you want to know this? Why would you want to know what beta is all about? Well, the thing is what beta really tells you is it tells you the volatility of a certain stock or security. So how big of those movements, how big, not a direction, but how large those movements can be for a stock or a security relative to a neutral level. So what does all this mean in layman's terms or in simple terms? Well, it means that if you're looking for a stable company, if you're looking for a stock that doesn't whipsaw around a lot, if you're looking for a stock that moves in a nice line fashion, you want a smaller beta. If you want a stock that moves around a lot quicker and has a higher potential to make you more money or has a higher potential to go to the upside quicker or go to the downside quicker, typically great for day trading as well, then you want a higher beta. So let's look at beta in depth. Basically, the stock market itself, okay, so the market itself has a beta of 1, okay? So if we have the market as a beta of 1, this is how it moves. So let's just pretend that this angle and this volatility is 1, okay? Stocks that have a higher volatility will have a higher beta. So they may have a beta of something like, let's just say 1.3. And if you have a beta of 1.3, this means typically you're 30% more volatile than the market. So that volatility may be something more like this. So that stock has a greater volatility as it's going up or down. Now, if we're looking for lower betas, companies like Microsoft or Procter & Gamble, if you're looking for a beta of, let's say, 0.8, so this would be 0.8, that volatility might be something like this. It might be very small, and it moves very slow. It moves very slow to the upside or the downside. So you're a little bit more stable, and that's why when things are in a panic, they sell off very big. People jump to the lower beta stocks. They jump to the ones that have more stability. On the other hand, when things are going great, they'll jump into the higher beta names because that is what they want. They want a huge run to the upside. They want the fastest stocks that are moving the quickest in the shortest amount of time. All right, so here what I've actually took a moment to do is write down the different betas for different companies. So Apple right here, as you can see, we have a beta of 1.06. So what does that mean? That means that it moves very similar to the stock market, and especially now that it had the stock split and so forth. So 1.06 is it's moving relative to how the market is moving in terms of volatility, how violent it's moving. Procter & Gamble here, P&G, is moving at 0.89 beta. So that means it's more stable than the market. It moves slower than the market. Verizon, we have 0.67, which means, again, it's even slower. It's more stable than the current market, than the way it is. It's moving at a stable pace. Now, if we take a look at these next two, like Netflix and Priceline, they move at a higher beta than the market. So that's 1.44 for Netflix and 1.51 for Priceline, which means that they move about 51% or 44% more than the market moves in terms of volatility. So in the end, what does this mean and what does it do to help you choose stocks? Well, if you're not a great stock picker, if you're not looking at technical analysis as much, one of the ways to see how violent a stock moves is to look at this beta. And when you're looking at the beta, you're able to see that violence, the violent swings that that stock can have. If you have a portfolio that is extremely volatile, you probably have a lot of beta, okay? On the other hand, if you want something a little bit more stable, you probably want things that have a lower beta. So if you're having wild swings and you're not able to digest those swings emotionally, then you may need to get something with less beta, less volatility. or you could trade less shares, of course. But if you're moving too slow, if things are just moving really, really slow in the markets for you and your stocks and your investments, then you probably have too low of a beta. And you want a little more beta so that way you can have more upside swings or more movement in the markets, whether that's upside or downside, depending on if you're trading long or short. Now, I personally don't know your investment style, your risk appetite, your personal plan, your risk tolerance, and all those other things along with your goals and retirement strategies. So for you, you might have a higher beta than me or a lower beta than me or higher or lower than someone else that you know. And it's not that important of what type of beta that you have. What's more important is you get the beta that suits your needs. Now, on the other hand, once you get more comfortable with choosing stocks, once you get a little bit more insight about stocks, how they move, how they act, how they behave on a day-to-day basis, you will already have an inside feeling. You will already have some insight to knowing how they really move on a day-to-day basis. You will know that Apple moves a lot more than Procter & Gamble or Verizon on a typical day-to-day, or Netflix moves a lot more than Procter & Gamble and Verizon and Apple on a day-to-day basis. So that's just part of just being in the markets and watching those charts on a day-to-day basis. Over time, you probably won't really need to look at the beta, but initially, if you're getting started, looking at the beta on the chart or on those reports is really helpful and handy when you're just getting started. And especially if you're looking for kind of a buy and hold or a longer term portfolio, it gives you a good way to kind of figure out how much risk and volatility you want within your account. Thanks for joining me and watching this video. If you enjoyed this video and you want to see other videos like this one, or you want to stay up to date to some of the free trainings that I have available for my newsletter members, then go ahead, click this link right over here. And when you get there, enter your name and email address, and I'll be sure to send you some of those reports and newsletters when they are released. And when you're on that link, don't forget to check out some of the courses, books, and other products that I have available. Thanks again for joining me, and remember to do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.